Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from Global Alts Miami by iConnections, and joining me for this segment, we have Kathryn Rooney Vera. She's Chief Economist and Chief Investment Strategist at StoneX, and we're here to discuss the macro environment and why institutional investors are increasingly looking for exposure to alternative investments. Kathryn, it is great to have you with us. Welcome to Trade Talks, and it's interesting as a Chief Economist and having your macro outlook. It's changing. The headlines are really fast. Policies evolving. What's your outlook in terms of where we currently stand right now?
You're right, Jill, and things are changing, but at the same time, some things are staying the same. For example, inflation. You have a negative correlation between fixed income and equities when you get inflation decelerating and you get interest rates declining. If you don't expect those two things to occur, then more likely than not, you're going to see a still positive correlation between equities and fixed income. So in my view, inflation is unlikely to hit the 2% target in the foreseeable future, and it's even unlikely to continue this disinflationary trend. If I'm right on that, and I've been out of consensus, now it's increasingly consensus, but I've been out of consensus for a few months now, the Fed doesn't cut anymore this year. And in fact, I'd go even so far as to say that if the US economy continues to grow at an above trend rate, which it is, so if we get the risk of overheating and we get a reacceleration in inflation, then the Fed could even potentially hike. And that has direct ramifications on the correlation between what has historically been negative between equities and fixed income.
And that's interesting. It makes you wonder how many people have modeled that out, right? Because for all intents and purposes, I do agree with you. If the economy is still functioning the way that it is and it's continuing to stay strong, do you necessarily want to take one of those tools out of the toolbox and cut for the sake of cutting when, to your point, if the scenario were to reverse and you think about increasing rates, I don't think the market has modeled that in that much.
Yeah, far from it. And I would say that yes, if the economy becomes more robust and core PCE moves from where it is right now, about 2.6%, and in a disinflationary trend, and reverses that and moves towards, let's call it 3.5%, I think the market will very quickly start to discount this possibility. It's not my base case, but it's something that I'm advising our institutional clients, Jill, to take into consideration, because the economy is very strong. And I'll add one more thing, which is the new administration is pro-growth, which sounds awesome, except it's also pro-cyclical in the sense that the economy is already growing above potential. So if you juice it and turbocharge it with additional pro-growth policies, which from the market's perspective are great, less regulation, lower taxes, animal spirits, the S&P making new record highs, all of that, you're not going to get inflation to continue to decelerate, and you're not going to get rates lower. So I think the risk is higher than the market is currently anticipating, that there could be higher inflation down the line.
Yeah, and I also think there's always going to be that disconnect, particularly from the public perspective, that the economy is not the market and vice versa.
That's true.
And the administration benches itself heavily on what's happening with the economy and the market. So I think that is going to be interesting to see how that plays into their calculus. Let's talk about institutional investors removing themselves from just stocks and bonds. They are increasingly exposing to alternative investments for that diversification within their portfolios.
They have to be, because as we talked about and has been the case of late, you're now seeing a positive correlation between stocks and bonds. So what has historically been a hedge for your equity portfolio is no longer. And that's the bond market, that's treasuries. So everything falls, everything rises simultaneously, then you have to look elsewhere for diversification. And this is what I'm telling my clients. If you do not expect rates to come down and inflation to come down, expect that correlation to remain positive. If that's the case, you need to find alternative sources of protection to protect your gains. And I'm recommending in the equity space the purchase of put options. It's done very well, actually. I've been recommending the purchase of protective puts on the technology sector, which is one of the most vulnerable sectors to high interest rates, and has performed, as everyone and their mother knows, exceedingly well.
Right.
So protect those gains, protect your S&P gains, buy puts, buy gold. If you like cryptos, it's not my space, but it could be an alternative asset class. But start to look into assets that have low correlations to the public markets.
It's interesting when you think of alternative investments, it's not just like, okay, equities or stocks.
Right.
There are a number of subsectors. It could be music royalties, art, real estate, digital assets is a growing subsector of it. What areas, you had mentioned gold before, are more attractive? How do you advise clients when it comes to liquidity profiles, because they are very different among the subsectors?
They sure are, and some of them are already pretty fairly bid up. as you and I
Right.
were discussing earlier.
Yeah.
They've already seen a lot of bids hit for private credit, private equity. So yeah, I do think there are options out there. You could look at real assets, for example. I like gold. I think gold is going to catch an additional bid because up to this point, what has been pushing gold higher has been the purchase by central banks. Now we're moving into the private sector. Those guys are going to pick up the pace. So I do think gold sees additional upside. And in general, I would just look for alternative asset classes that have low correlation. So you have to do your homework, find what works for you, but look for low correlated assets with equities and bonds.
That means there will be pieces of your portfolio that you might not like because of the correlation factor there.
That's absolutely right. And I think it's going to be clutch going into the next 12 to 18 months.
Right.
I think recession is a very low risk. So if you want to protect against inflation, you do want to hold gold. You want to hold tips. You want to hold even defensive sectors in the S&P. My biggest call last year was utilities. Utilities rose 30%. And my big call last year for 2024 was utilities, precisely because it's both a defensive, but it also is a second derivative to the tech play.
Right.
Tech has already run its course. We're in a mature phase of tech now. You can't just throw out the buzzword automation and AI on your earnings call and expect a $5 jump in your equity price. In your stock price. So we're in a mature phase now. Find those second derivatives. I also like healthcare. Healthcare was the least best performing last year. And I think it has some aspects to it with regard to automation that can make it do well over the course of the next coming year. So I like that, and I like the equally weighted S&P.
What about are you concerned that there's too much exposure to private credit? It's almost becoming the buzzword. In the course of our coverage, there's certain words that every 6 months or so you hear, and private credit, it constantly comes up.
Yes, I do agree with that, and I think there's a lot of interest in it precisely because people are looking for additional sources of return, additional sources of diversification. But this is pretty opaque. We don't know really what's going on, and how vulnerable it could be in front of a reversal in the interest rate policy. So that we don't know, and I am concerned about. I do think it's a pretty crowded trade. So do your homework.
Right, I appreciate the insight, Kathryn. Thanks for joining us on Trade Talks, and thanks for joining me from Global Alts. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.